Hello and welcome for this week's market dashboard, July 4th, 2025. So happy July 4th, happy Independence Day for this market dashboard. I hope to be quicker for this shortened week in the market. So let's not lose any time and just check a couple numbers. You see that the S&P, you've probably seen it, that has hit an all-time high. Same for Nasdaq. Bitcoin is at an all-time high as well, at least on a weekly basis here. Gold is not very far from the all-time highs as well, so everything looks good. If you look at the sigma, the volatility ratios, which kind of measure the activity on the markets, all these ratios are pretty low at this time, so no excessive activity, no perceived risk. I've seen that some of greed fee indicators from some major banks are back in the greed area, which again is not exactly surprising, with again stocks at all-time highs, the VIX back to very low levels. So all of this is not surprising. If you look at the performance, the bars below, you see that so the S&P had a good week, gold had a good week, Bitcoin had a good week, and oil had a good week as well. So everything looks good, except maybe slightly bonds and the US dollar, but we'll talk about this in a couple of seconds. So again, same thing here, exactly what I just said. All-time high on the S&P and volatility back to pretty low levels at this time. So no concern in the markets for investors, at least for equities. Again, similar thing for the average activity ratios. We are back to regular historical levels. So again, nothing to be concerned here. And I wanted to show you this. This is the risk-adjusted momentum of the major asset class here. So, and you see that at the top, we see the S&P and both gold being at the top of the risk-adjusted momentum. So that could be seen as contradictory, as one is a risk-on asset, the other one is a risk-off asset. However, what drives the S&P higher potentially is the famous or infamous big beautiful bill, which the US debt still growing will participate to the currency debasement, which obviously inflates all assets, including stocks, and generates risk of inflation, which is favorable to gold as well. So what can be seen as a contradiction at some point is actually not really one specifically in this situation. You see that the US dollar is still on a downside. Bonds are not really improving at this point, and again for the same reason, the big beautiful bill, not only again it will be inflationary, so interest rates potentially rising, and on the jobs report that was better than expected. This is another inflationary push that is supporting higher interest rates, which again limits the bonds recovery at this point. So what we can see here is foreign markets versus the S&P 500, and after the trend that we've seen since the beginning of the year, where foreign markets were overperforming the US equity markets, now this trend has stopped and is kind of started reverting. This is not surprising. The US is the major equity market in the world, and once you remove most of the issues that may come back actually on tariffs, plus inflating the assets in the US by more government spending and currency debasement, then you can have that kind of situation where the trend stops and reverts back to where we were before, in a situation where historically the US market is overperforming foreign markets, and this is going back to where we were before. And maybe the last one which is a chart that I've shared a couple of times, which is the theoretical exposure of a strategy that would target 10% volatility for each asset. And here on bonds, on gold, on S&P 500, so US equities, and potentially Bitcoin. And what I wanted to show you this is that, you know, the markets now being quieter, we have a releveraging, global releveraging on every asset classes at this time. It's getting quieter, volatilities are going down, so all funds that are exposing to the market based on some risk adjustment, then they are releveraging at this time. So again, this is another push for these assets, you know, basically all assets going up, and this is giving some support at this time. Obviously there will be some, you know, moves between going back and forth, risk on, risk off asset, as we've seen between gold and the S&P, for instance, but this is where it's going at this time. Again, this may change. You know that very soon the pause in tariffs will stop. There are deals that have been signed. There are new deals that needs to be signed, but we'll see. I believe it was on July 9th, which trade deals are signed and which are not. And this again may give a little bit of stress to the market until we go until the 9th of July and see what actually happens on this day. So that's it for this week. This was way quicker than usual. You know, there was nothing much to say. Most market going up, no crisis, everything was quiet. It was a shorter week, so this is where we are now. But I would expect the craziness to keep up over the next week for again a simple reason, just like, you know, tariffs back on the, you know, as the center of the stage of the news, potentially US government deficit. We still have some debt to roll around August, and there will be the fight around Jay Powell at the head of the Fed, because we know that Trump wants to have much lower interest rates, which Powell and the Fed doesn't really want to because of the potential inflation coming, supported by the better than expected jobs number this week. So we'll see what happens, but potentially still more drama to come. Thank you, and see you next week. Bye-bye. Enjoy your 4th of July weekend. Bye-bye.